So today we're going to cover how to spot absorption in a realistic and factual way, not like the abstract and, in my eyes, useless way. Different other strategies and concepts look for absorption. We're going to use actual market orders, look at actual delta, and look at how the actual participants are making their decisions to figure out where there is absorption. So the way we do this is use a few different tools. First, we start off by using something called delta. What is delta? Well, delta is the difference between the buy and sell volume. So for example, I can zoom in here a bit. In this candle here, there was 11.6 million in volume, but there were 2.2 million more buy volume than sell volume. Also, we can go, for example, here on this candle here, this gray one. There was 3.5 mil in actual volume, but there were 2.2 mil more sells than buys. So that's what delta is. We're also going to use something called CVD, cumulative volume delta. What that is essentially delta added together from all the individual candles over a specific time, usually the daily. And this is recorded two ways, either in the footprint like we have here, or in delta bars, which we have here. So how do you use these tools to look for absorption? First, I have to note that delta is very, very subjective because there is no mechanical rule. You can only make decisions based off discretion, essentially experience. There's no number for delta in which there will be absorption, because one day it might take 20 million in negative delta to form a bottom. Another day it might be 50 mil. Another day it might be 25 mil. It all depends on the amount of volume and whether and where the passive participants decides to step in. So how do you use these to look for absorption? Well, first you look for delta spikes in D bars. So delta bars. What this means is you want to see a spike in this delta bar here, or another tool you might use. Spike above the average, essentially. You can see here there's been average, not that big of a delta, but we have several spikes there, etc. So that's what you want to look for. You also want to look for CVD divergence. This means that when price, for example, makes a lower high, and CVD making a higher high, or price making higher lows, while CVD is making lower lows. You can view this if you go to the D-bars. This is on XO charts. It's my favorite platform. D-bars, turn off the histogram mode, and now you can see how CVD is over time. So that's what you're looking for, either divergence in CVD or delta spikes in D-bars. So building on the delta spikes, like I said, you're going to be looking for spikes in delta, so either spikes in positive delta or spikes in negative delta. Next, you're going to look for a P-style body or a B-style body. For example, here we have a negative delta candle. You see there's massive gray here. Gray is my color for negative delta. We have a star of the B, and then we have the rest of the B here, right? So we have massive selling, so negative delta, and we also have a spike in negative delta here. Why does this show absorption? Well, it shows absorption because if this massive negative delta isn't able to push price down lower, it's essentially because passive orders or the market makers are absorbing all of the selling. Because this delta is only showing market orders, it's not showing you limit orders. Because then there wouldn't be no delta, because all orders are one-to-one. So for every buy there's a sell, and vice versa. So this is only showing you market orders, okay? So like I said, if this massive negative delta, massive selling, isn't able to push the price down lower, it is because passive orders or market makers are stepping in and absorbing all the selling. So we have a B style candle, we have a massive down tick in delta, and we get a reversion. Vice versa for buying delta, we have a massive uptick in delta, positive delta, 18 mil, and we have a P style body. Okay, P is here, start of the P, and then the P here. Okay, same thing here. If the massive buying volume isn't able to push the price higher, it is because of the passive orders, so the market makers, stepping in and absorbing all the buying, and this will lead to a reversion. So purely playing off these concepts, in this case, would first net you a 0.5% move on Bitcoin, so we'll leverage that a lot. And next, another 0.4% move. And this is in the span of 10 minutes, okay? And these are opportunities that happen all the time. We can just scroll a bit more. Here again, massive positive delta. We get a massive green candle, massive positive delta in the candle as well. And because the price isn't able to be pushed higher, it's because, again, passive sellers are absorbing all the buyers, and we get a reversion. You look down here again, looks for another spike. Here again, we have massive spike in delta, not be able to push the price higher. We get a P candle here, and we get a reversion all the way back down. Let's look for a last example here. Here again, massive downtick in negative delta. We get a B style candle, clearly, and we get a reversion. Okay. Next, we're going to cover the CVD divergence. Let me go back to where we were. That was here. So now I'm going to go to the turn off the histogram mode. Do a session here. Now we're going to look for higher lows. So let's say price is making lower highs, while CVD is making higher highs. That means the ask or the sellers are absorbing. And if price is making higher lows, while the CVD is making lower lows, that means the bidder are absorbing or the buyers are absorbing. So let's look for a divergence, okay? Okay, here we have an example. Price here, CVD here is making a higher high, while price is making a lower low. This is showing you that the ask or the selling is absorbing the buying, and we get a pull down, okay? For this, you only want to use regular divergences, no hidden or weak divergences, only regular divergences. And the pitfall with CVD divergences is like any other divergence, it rarely plays out immediately. The price might continue to push against the divergence for a while before playing out. And divergences is usually best used on somewhat higher time frames, so above the 15-minute. I'm currently on the 3-minute, so it's kind of difficult to show working examples because it's not really to be used on lower time frames. But for delta bars and delta spikes, that's to be used on lower time frames. Another point here is that absorption, so these concepts that I've been talking about, should only be used for reversion, never use them for continuation, okay? Because it's difficult to extract info about them to use for continuation, but mostly for reversion. So we can look for some more examples here. If we turn this back to histogram mode, let's see. That was another example I was already showing. Let's go back a bit. We can go all the way down here. Okay, so we had a massive push in delta, massive push in price, P style candle. Start of the P, and we get a reversion. Let's look for another example. Here again, push in delta, P style, reversion, push in delta, reversion. Let's look for some negative ones. negative delta, B-style body, reversion, etc. You get the point, right? So this is very, very nice to use for scalping. You can get some very, very nice moves off this. And if you just composite all your profits here, you can make some really good money with this. Even though they're just, let's say this one, if you use this example, very good example. Even though this is only, what, a 1% move, this took 10 minutes to play out, okay? And there's chances like this all the time, okay? So let's say you use 50x leverage, 50% move, done. 10 minutes, done all the time. So it's a super useful strategy for scalping. Right, that's it. Thank you.